It's all going to hell in a handbasket. And I got a front row seat. How bad is the crypto world about to get? I'm going to tell you in this video. If you haven't been paying attention recently, FTX has filed for bankruptcy, the second largest crypto exchange in the world, ran by America's golden boy of crypto, the man who was supposed to be the Jamie Dimon of the crypto world, with the FTX group of companies being the JP Morgan. Last week, we covered the rise and fall in detail. This week, we're going to cover the damage it has caused everyone around it. I want to talk about Contagion. What does this one large event mean for all the partners, lenders, depositors, promoters, regulators, and stakeholders involved with the FTX insolvency? Let's start with a basic example of Contagion and what it looks like in the crypto space. I stole this idea from one of my favorite writers, Matt Levine over at Bloomberg. So let's pretend that we got a great company. Okay, they're well capitalized. So this company's going to take their great balance sheet and they're going to approach users and say, hey, if you guys give us your digital assets, so that could be Bitcoin, stable coins, tokens, NFTs, you name it, we are going to give you yield in return. So that's interest. Could be in the form of dollars, Tether, their own native token. They can get creative here. Now, in taking those digital assets from users and paying out yield, they've got to find a way to make money off those digital assets. So what they're going to do is they're going to find various crypto funds and they're going to agree to lend them those digital assets in exchange for those crypto funds paying interest or yield back to the great company. So effectively what this great company is doing is that they are borrowing short and lending long. Now this works really well in an environment where crypto is relatively stable or moving upwards. So let's paint out a different scenario where there's a lot of volatility. I'm going to call this scenario hell in a handbasket. So in this scenario, for whatever reason, users are nervous about the price of their digital assets, so they start to request them back from the company. Initially, this great company is fine because they're well capitalized. They can begin to return the digital assets to the users. But there's obviously a problem because they have lended out most of those digital assets to various crypto funds, and they have lended those on longer term agreements. So now if there are enough users requesting their crypto or digital assets back, this great company finds themselves in what we call a liquidity crunch. This great company may be perfectly solvent, but they ain't perfectly liquid. And this is the problem with a bank run. What if those individual users are kind of their own bank and they're doing some hedging and they're holding on to other people's or firms' deposits? Now they can't access that crypto. But remember, crypto markets are tanking. Even worse, what if those tanking markets impact leveraged firms and they get margin called? Well, now they have to start pulling out funds or declaring bankruptcy. This causes a series of domino effects, and because not everyone is well capitalized, it snowballs. For example, and there are many of these, in under 1 hour, we saw nearly $900 million of Bitcoin get moved off Gate.io. And Reuters is reporting that as of November 16th, there has been more than $190 billion wiped from the value of the overall crypto market. And we have people like Michael Saylor and CZ from Binance encouraging people to get their money off centralized exchanges, which is odd that CZ is saying that, but let's stay on track. We do know this. John Ray III, who is now considered the CEO of FTX & Co. on behalf of all the debtors, has worked on various files in the past. One of them notably was Enron, which was one of the most well-known frauds in the world. And even though he's had a first-hand look at the skeletons in some of the deadliest closets, Mr. Ray already had this to say about FTX. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. So when it comes to the contagion that FTX has caused, where do we even begin? The biggest loser so far appears to be Genesis, who suspended redemptions and new loan originations with its lending business, saying on Twitter, FTX has created unprecedented market turmoil, resulting in abnormal withdrawal requests, which have exceeded our current liquidity. Last week, Genesis was given $140 million in equity from their parent company, Digital Currency Group Holdings, to cover the hole left in their balance sheet as a result of this debacle. And a week later, we discovered that that wasn't enough, as a report in the Wall Street Journal tells us that Genesis is now looking to raise up to $1 billion in an emergency loan. And now Gemini, who is ran by the Winklevoss twins, said redemptions by customers for its Earn program are now delayed after partnering with Genesis, who paused withdrawals on its borrowing platform amid this liquidity crunch. And this isn't the first time that Genesis has been burned badly by issuing a loan. They previously lent $2.4 billion to Three Arrows Capital, and today have a $1.2 billion claim against 3AC remaining from the loan. Which, in case you don't remember, 3AC famously blew up after the Terra Luna stablecoin meltdown, which at the time 3AC also reportedly had up to $350 million of loans with Voyager Digital, who FTX was attempting to purchase shortly after Voyager's demise thanks to their involvement with 3AC. We can also add BlockFi to this web, who just like Voyager lent money to 3AC and found themselves ultimately insolvent and in an attempted purchase by FTX, which today we found out that BlockFi received a principal loan of $250 million in FTT tokens from FTX. Anyways, are you confused yet? Can you see how incestuous and complicated the crypto universe has become? Here's some quick examples of other funds experiencing issues thanks to this whole FTX insolvency. Sino Global, who managed up to $300 million in assets back in January, announced a mid-seven-figure exposure to FTX. Pantera Capital, who is said to be one of the largest crypto funds out there, is said to have 3% of their assets under management on FTX. Sequoia Capital has lost over $210 million in investments between two of their funds. Galwa Capital, commonly known for shorting Luna, had 50% of their assets on FTX. Multicoin Capital lost more than half of its flagship fund's capital. Ikigai, a $30 million VC fund, had what they called a large majority of their assets on FTX. The Ontario Teachers Pension Fund got dinged for $95 million. And Galaxy Digital revealed they had $76.8 million in FTX exposure. Look, I could keep going with lots of other stories, but the scary thing here is what we don't know. Voyager originally told us everything was fine because they didn't hold any customer assets on Celsius, which we later found out that they had made loans to the exposure of $655 million to Three Arrows Capital. Celsius wrote a blog post saying, "Damn the torpedoes, full speed ahead," blaming the naysayers for spreading misinformation. And well, we can see how that one worked out. At this point, I think you get it. And of course, it goes well beyond lenders, exchanges, and funds. Let's think of the poor celebrities that were impacted by SBF's negligence. First, we got Tom Brady.
Sam from FTX.
Then we got Steph Curry.
Everything I need to buy, sell, and trade crypto safely.
Curb your enthusiasm, folks, because we've also got Larry David.
And I'm never wrong about this stuff.
Now, of course, all these celebrities are getting named in lawsuits. But wait, I'm forgetting somebody, aren't I? Oh yeah, Canada's favorite investment guru, Kevin O'Leary.
I own 32 different positions, including equity in FTX. And I have to disclose, I'm a paid spokesperson for that company.
Okay, so he invested and was a spokesperson. It's not like he said stupid stuff discussing how safe it was to be on FTX, right?
If there's ever a place I could be that I'm not going to get in trouble, it's going to be at FTX.
Whew, but you learned your lesson, right, Kevin?
If SPF knocked on your door again and said, look, I failed in my last venture. I have a new crypto venture. I need money. Would you back him?
That's a great question. No one's asked me yet.
Would you back him?
The answer would be yes.
For f***'s sake, can't we just revoke this guy's citizenship already? So it looks like a few celebrities are eating some crow, some large funds took a hit, and a few rich Ponzi-like structures got taken down. Who's the big loser here? I mean, did I forget somebody? Oh yeah, the user. FTX claims that they have 1 million users in the US and millions outside of the US. In most cases, we're talking about the butcher, the baker, the candlestick maker, the person who works an extra shift, putting their hard-earned dollars on a platform and gambling with it. Sure, it's crypto, so it's insanely dumb. None of it's productive, and it's based purely on speculation. But hey, maybe I'll throw $100 on the Argos this weekend during the Grey Cup to make it more interesting. What do I know? The only player I vaguely recognize is Jim Kelly's asshole nephew, Chad Kelly.
It's not cold enough!
But the point is this. I expect to put some money down. Maybe I win, maybe I lose, but I expect that money to be there should I win. I don't expect it to go to some 30-year-old turd who brags about wokeness to play up to the media with a group of his nerdling friends stealing my money to form a sex cult in a penthouse in the Bahamas. I digress. Any sane person who has any money on any single one of these centralized exchanges ought to be on the phone or at their bank doing everything they can to get their money or crypto off that exchange. No exchange is safe, And this, folks, is bad for the entire crypto space. If crypto is still a thing in 10 years, it badly needs regulations, oversight, compliance, laws, pretty much everything that scammers hate. I don't know. Maybe even the second largest crypto exchange in the world should have a board of directors. Look, there will still be scams, but at least investors and traders will have the ability to have some level of transparency to look at. For now, expect more failures, expect more fireworks, and remember, just because a company tells you everything is fine, don't assume it is. Thanks for watching, everyone. I leave you with this clip I found on the internets of Matt Levine and Sam Bankman-Fried, sort of joking but sort of serious about how if a crypto exchange found itself in liquidity issues, it would be pretty likely that they would misappropriate customers' funds.
So, okay, of the calls we might get, the best case is when they have about zero left, right? And, you know, they're like, look, we need a buffer here so we can, like, definitely pay salaries without dipping into customer funds, like, you know, and we're like, that makes sense, right? And in those cases, like, what we would tend to do is, like, okay.
Because otherwise they would.
Well, depending on the company, right? Otherwise, maybe they would declare bankruptcy, or maybe they would dip into customer, whatever.